Hi, this is Jim in New York. Hey, do you see any signs that a couple of our macro managers are hinting at this, that the property bubble will reform as an equity bubble?
Peter, do you know this, like in terms of size, the housing market versus the property market? I think property market, no, I'm sorry, the equity market is still very small compared to housing market, right?
Oh, that is correct. Yeah, as an asset class, shares are much smaller in urban China than properties. But it is an interesting question because we've seen an amazing increase in share prices in the last 4 months or so, 60% up or more. That while the economy is slowing, and I think the most plausible explanation for this otherwise hard to understand development is that many people with money, many speculators have given up on the property markets and now putting their money in the stock exchange, particularly now this direct link with Hong Kong has become a possibility. I don't have another good explanation for the runaway stock prices.
And then obviously a lot of purchases and transactions have been done on margins, right? So, into account with the investment amount exceeding X, whether it's million or hundreds of thousands renminbi, they can borrow up to Y times from their brokers, and then the brokers kind of turn around and I don't have, there's a double story in it. They turn around, then they sell it to a brokers or something.
Well, I think if you allow me to interject, I don't know either precisely what's going on, but one broad perspective on the Chinese property markets and stock exchanges is that we are still in the middle of a huge process of financial sector adjustment, which was heavily controlled by the party, which is now slowly liberalizing, partly as a result of the spontaneous development of shadow banking, but partly also because the big financial bosses wanted to go that way. They want to move in the direction of a more liberalized financial markets. But this is still, we are in the middle of that, so anything can happen. The shift from property markets to stock prices to shares is one possible explanation for the runaway price increases in the last quarter of last year. Another possibility is, which I think is also a reality, is that a lot of the brokers have opened up to margin financing. And a lot of the shares are not only bought with own equity, own capital, but with borrowed money, which is potentially very dangerous, of course. And when the authorities in Beijing realized that a lot of the share buying was actually financed with borrowed money, they clamped down on the margin buying, which at least temporarily for about a week and a half caused the price increase to hold and temporarily reverse. So let's not try to understand all the details. We are in the middle of a huge structural financial sector adjustment process, and that will take several more years. In the meantime, all sorts of crazy things can happen.
Yeah, so in other words, volatility will be tremendous.
Or just a few general comments. I still believe that we are in the middle of an adjustment, a cyclical adjustment process in the property markets, and not on the way down to a huge crisis. It threatened to become a crisis when the bubble became very serious in 2009 and 2010, but after the very intensive government efforts to cool demand, particularly speculative demand for the higher end markets, they seem to have succeeded, at least so far, in capping the bubble. Totally different evolution of events that we had in the US where the bubble was allowed to grow ad infinitum in 2004, 5, 6. So it's a very obscure situation, very hard to put your arms around it. I believe that the adjustment process may take another 1 or 2, possibly 2.5 years, but no crisis. There are some indications in just recent weeks, but Junheng would know much more about it than I do, that at least in some parts of this huge urban residential property market, there is an upturn. There was an auction for land, development land in Beijing 2 weeks ago, where prices went through the roof. Everybody was surprised that for the first time in years, developers were bidding up the prices for urban land in Beijing. But Beijing, of course, is not representative of the urban property markets in China. It's far too big to generalize. The other indication we have that there may be something more positive developing is an upturn in average prices in recent weeks or months. I'm not sure that I can show you the graph, but a research assistant of mine, if I could just hold it in front of the camera, showed that in all the major cities, Shenzhen, Shanghai, Tianjin, Beijing, Chengdu, Chongqing, and Guangzhou, in recent weeks at least, average property prices as transacted have moved up. And the combination of these two developments, the auction in the land auction in Beijing and the NBS numbers on property transactional prices in some major cities, suggests to me that perhaps the end of the downturn or the cyclical adjustment period is closer than we previously thought. If we are so lucky, then all these dire predictions about a hard landing for the whole economy or sliding down to 3 or 4% growth, I think are overblown. We all know how important the property sector is in the overall Chinese economy. It probably, in recent years, accounted for at least 25% of GDP. If you include all the industries that are dependent on the property sales, like steel and aluminum and doors and all the faucets and what have you, that's a significant part of the Chinese economy. So if that turns up, then it will have a positive effect on many parts of the economy, particularly in the manufacturing sector. But it's too early to make that call. I am very cautiously optimistic that we are going to avoid a crisis, both a real estate crisis and a financial crisis, and that even though the slowdown will probably continue for a while, that we are in more likely have a sustainable, relatively high growth path for the next 15 years. Malcolm, just to clarify one point I tried to make in my first comment. The evolution of the Chinese real estate bubble, which threatened to undermine stability of the property and financial markets a few years ago when they started their stimulus program, the evolution of that bubble is totally different from what happened in the United States in the years leading up to our financial crisis in 2008. Greenspan and his associates who ran the Fed at that time did not want to recognize that there was a bubble developing. And even if they were willing to acknowledge that there was a bubble, their conclusion was that's not our problem. We cannot recognize bubble, and even if we could recognize bubble, we don't know what to do about it. This is the market. It's easier to clean up after the bubble burst than try to control the bubble. The Chinese approach to their bubble, which began to become serious after so much liquidity was pumped in the economy from the end of 2008 onward, the Chinese official response has been totally different from Greenspan's. Their response has been, if there is a bubble, we better recognize it and try to do something about it. That's why they began to introduce all these administrative buying restrictions in April of 2010. Then the market overreacted to that. Prices actually went down, and they didn't want that either because they were afraid that that might slow down the economy too much. So they began to remove some of these administrative restrictions again last year. And it seems that the Chinese, although it is too early to tell, it seems that they have succeeded in controlling a very dangerous bubble, which the US was unable to do.
It's Pieter said that one thing that's exactly right. It's a really tough thing to put hands around it, because we've been seeing really conflicting data points. On the reported, like 43 key cities, the transaction volume prices, it seems like stabilizing. But when we talk to developers and follow, individual, because we've been doing, 2 projects, big projects each city for 12 cities over the past year. Price deceleration pretty clear, not big, anywhere between 5% to 10%. That's on the explicit side, but there's obviously implicit discounting, such as giving, free parking lot, auto licenses, etc., etc. So if you take those into consideration, it might be 10 to 15%, but still less than what we had thought a year ago. And when we talk to developers, and when we talk to the online transaction guys who sell apartments for developers, just things do not look great. I mean, they themselves, the people on the ground, that do not share confidence as most people on Wall Street in the investment community seems to share. So I mean, there's definitely conflicting data points. So that's really sort of our observation.
A lot of people have been saying for a long time that this real estate market in China is a bubble, but as Pieter mentioned, in the last month, housing prices have actually turned up, which is not what happens in a speculative bubble popping. So I just wanted to see if there was anybody still on the bubble bandwagon, and what people who still were had to say about that.
I really think that you need to wait out a little bit, because of Chinese New Year. I think all those and the timing of it. Last year was the last day of January. This year is mid of February. So what we do is we got those like weekly data. We kind of just ignore them, and we're going to combine January and February, and then perhaps the combination tells a better story as opposed to, year to date. 6 weeks, whatever. I think that's. I mean, it's a little bit like kind of. It has seasonality bias to it because of the timing of Chinese New Year.
Yeah, that makes sense. I've heard a lot of people say that a lot of data coming out of January and February is tough to compare because of the New Year falling in different dates. So do you think that next month we're going to see the numbers drop back down again?
I think January and February, once you have the February number and January number, of course, then you combine the two, and then it's more apple to apple, as opposed to Jan to Jan, the Feb to Feb.
I have a question. I'm wondering, Junheng, if you're hearing what you are hearing about the restructuring of Kaisa in Shenzhen.
I guess they're showing up in court, and then there are recent articles and some report by Nomura analysts saying that it revealed a web of related party transactions and all that things. I mean, I think what our read is, it's obviously the government, the central government, doesn't really care to push the small private developers under. I mean, I just think the way it deals with it probably not very friendly to minority shareholders who were dragged all the way down as well. But it's obviously, I mean, if you are if you are a developer, I mean, what's the chance of you not corrupt, right? I mean, it's so I mean, how do you get land? How do you get all those access to resources? So I mean, it's no doubt then all those guys have some sort of questionable dealings in the behavior, but it's just who gets singled out. In this case, Kaisa did, and I don't know if Sunak is really like seriously in concluding a stage with in conversation with Kaisa. So I mean, they offered a purchase price, but then it turned out that Kaisa seems like owns a lot more debt than it claimed to be, or like people expected at the beginning. So
this all started when the party people in Shenzhen realized that a local police chief in Shenzhen, who was on an annual salary of less than $12,000, owed 42 properties. So they began to suspect that that was a very strange situation, that there was a lot of corruption involved. And since the properties were all built by Kaisa, they thought that there was perhaps a link between this police chief and the Kaisa. So then the local authorities in Shenzhen banned Kaisa from selling more properties in that district of Shenzhen. that caused the bankruptcy of CHINA. So it's an incredibly complicated situation. And I think even if you can understand in detail what happened in this murky CHINA case, that doesn't help you a hell of a lot to understand the broader property market issues in China.
Well, I mean, but the thing is, I mean, so Kaiser did and Kaiser is caught. So, I mean, what you're describing in Shenzhen market, I mean, it's so easy to envision that it happened anywhere. In Shanghai, in Nanjing, in Chongqing, anywhere in smaller cities, particularly smaller cities. So yeah, the highly levered guys with lots of land bank in smaller cities, and they are more prone to be singled out and to be investigated and to be found with wrongdoings.
I mean, I think it's interesting that once the company got into trouble, it's a lot of off-balance sheet liabilities turned up that people didn't previously know about, and so forth and so on. But that's a fairly standard kind of story. I think it's not good from the point of view of the reliability of audited financials in China. And I don't think the foreign bondholders have much prospect of recovery.
One of the three owners of CHINA, one of the Kwok brothers, bailed out, I understand. They left Hong Kong and is somewhere. Now, this is a very murky case, and it is interesting, and it is indicative of the chaotic nature of many of the markets in China. But I don't think it's worth spending a lot of time trying to find out all the details, because if you find out all the details, you still don't have the broader picture.
Peter, I wonder if you have any insights on a similar situation, but slightly different. Minsheng Bank, the CEO being taken out and investigated, and we spoke with some people within Minsheng Bank. They were saying like all the non-cash business, so the basic banking businesses, including excluding the basic banking business such as cash and the cash management, the financial derivatives and interbank activities and bank notes trading, those are all told to be suspended. So like, do you have any insight on like why I mean, I guess not why, but like what would be the likely outcome in Minsheng being one of the largest non-SOE banks?
Yeah, I think you just summed up what I had heard about the case. I have no inside knowledge in the Minsheng. It's an interesting case, and it's probably mostly related to the anti-corruption drive and not to financial sector issues. But it's important because Minsheng, in the meantime, has become a sizable bank. It started as a very small bank when the IFC put 5% in it in 93 or 94. Now it's a sizable bank, even by international standards. But I don't really have any insights, no.
So what do you think? Do you think they would, so is it just going to be like a top executives turnaround, or not turnaround, but just like a reshuffling, or it's going to impact the bank's business and earnings kind of, for a while?
Yeah, my guess is that the party has limited control over Minsheng, because Minsheng is one of the few banks that has substantial non-party shareholding. It's sometimes referred to as China's first private bank. It was started in the mid-90s, as you know, with substantial IFC support. But I honestly don't know what's going on. It's all within the camp of Mr. Wang Qishan.
And then on the Kaiser deal, Peter, would you say that we are just, I mean, is it indicative of perhaps the anti-corruption now getting to the property market?
Yeah, I think the Kaiser case Kaiser is not a big company. Let's make that clear. It's a listed company in Hong Kong, but it's not one of the big developers. I think it is primarily a corruption case and not a property market case. They went bankrupt because they were banned from selling property in a large part of Shenzhen after the local party authorities had found out that the local police chief had acquired properties from Kaiser, presumably. It's very interesting that there have been some major changes in the Chinese balance of payments. For the first time in almost 15 years, in the last few months, in the last quarter. In December, starting in December, we have seen net deficits on the capital account, net outflow of money on the capital account. We still have large surpluses on the current account. The trade balance is more positive than it has been for years. But the significant new development is that on the capital side, money is now flowing out of China. And that is partly because of private capital flight. Corporations and individuals, whenever they get a chance, ship their money to Canada, the United States, Europe, Hong Kong, perhaps even. And partly because the official outflow of investment money, the ODI they call it, the overseas direct investment, is now larger than the FDI, the investment flow coming in. And that has created a new challenge for the monetary authorities, because previously a lot of money increase in the money supply was the result of surpluses both on the current account and on the capital account. That situation is now passé, and we don't know how much lies ahead, but the central bank has had to inject liquidity into the markets to compensate for the outflow of money on the capital account. They could have accomplished the same by lowering the RRR rate, the reserve requirement rate, which is unusually high at about 20%. But for reasons that aren't entirely clear, they choose another technique to inject liquidity into the economy, namely direct lending. They introduced 3 new facilities for lending directly to the banks, the corporations, and others. And so we have a whole new monetary policy situation in China because of the turnaround in the capital account. And I must say, I'm trying to understand what's going on. I'm not in touch with these guys on a daily basis, but they're doing the right thing. They're ensuring that there is not too much of a liquidity squeeze. Otherwise, the short-term interest rates would have gone up even faster than they did. But they can no longer do what they did in the past. You know, from about 2003 onward, we had these huge surpluses, both on the current and the capital account, and the central bank intervened in the foreign exchange markets by buying up the dollars and by injecting liquidity, thereby injecting huge amounts of liquidity in the economy. So much so that they were very worried about inflation and began to sterilize part of what they had injected by buying the dollars. That is not going on at the present time. We have a totally different situation. There is more downward pressure on the exchange rate now than upward pressure, and there is a net outflow of capital on the capital account. Both two whole new situations that the central bank will have to deal with, and so far my impression is they're dealing with it in a very intelligent way, but not in a way that is sustainable in the long run. In the long run, they have to move towards a Fed-style indirect monetary management, rely far more on interest rates and far less on discrete interventions in the market.
RMB being soft pegged to US dollar, and it's so strong right now, and that really hurts China's global competitiveness. I just don't know, like, I mean, is devaluation a possibility? And, you know, that would be good for the economy. But I remember Pieter said that it is a possibility last time, right?
You mean further depreciation?
Yeah, depreciation.
Yeah, I think logically they have to depreciate the nominal dollar rate, if only because they have appreciated so much against a basket of currencies, which includes the yen and the euro. Depreciation really a conflict of for the central bank, because the traders all want to depreciate faster than what they are doing, yet the political bosses and the central bank want to push that renminbi overseas. That's called renminbi internationalization. They're very serious about that. They've been doing that actively since about 2009 overseas. You want to keep the dollar rate as stable as you can. So the central bank is trying to wiggle between those two conflicting objectives. That is pleasing the exporters in Guangdong and Fujian and Jiangsu, and pleasing the political bosses who want to see the renminbi to become a real competitor for the dollar in international capital markets.
As we speak, we just received a note from equity note from a Goldman analyst talking the leisure and travel analyst. So here's the one highlight relating to what we are discussing, relating to the currency and the tourism. Weak tourist arrival to Hong Kong during Chinese New Year is in sharp contrast to still strong Chinese outbound tourist growth, 9% during Chinese New Year, pointing to continued diversion of middle-class tourists. Korea, for example, saw 30% growth in PRC tourists during Chinese New Year. The China National Tourist Office also expects Japan Chinese New Year Chinese arrival to grow by 50% year over year, and I think it has so much to do with the weakening Japanese yen. I mean, it's just
absolutely now also the euro, of course.
I bet there's so many Chinese now in Italy and in Spain.
I don't know where to come out on this, but I think if I had to bet my money, I would bet on continued depreciation against the US dollar for a while, and possibly even leveling off of the exchange rate, the real effective exchange rate against the basket of currency, because they're losing too much on export competitiveness. But that consideration is tempered by the observation that the trade surplus has begun to rise again. So all the complaints from the exporters must be very confusing for the monetary boys in Beijing, because they see the appreciation of the real effective exchange rate, which includes the dollar and the euro and the yen and everybody else, but they see the trade surplus rising, which you wouldn't have expected.
Do you know which area give the rise of rising export?
No, I don't know what the composition is. I do know
isn't the impact primarily from lower cost of imports? I mean, with oil and iron and copper and other commodities collapsing, the dollar value of imports has changed dramatically. So the terms of trade have moved in favor of China.
Yeah, that's probably a factor, but that does not only affect China. That affects all the countries in the region, and we don't see the growth in the trade surpluses except in China.
You know,
I am puzzled by that. What I do know is that the government is trying to push now very hard the export of construction services and heavy machinery exports. All these Silk Road plans that you may have heard about are in part motivated by the desire to export surplus capacity in construction industries and in heavy machinery industries. And if you look at in world construction activities, it's the Chinese corporations that win all the contracts at the moment in Central and Western Asia, in Eastern Europe, in Africa, in the Middle East. It's all Chinese construction companies, which is part of their deliberate strategy. And that, I think, is beginning to show up in exports also.
But Pieter, that's that's going to be very volatile though, because the area, the destination you just cited, Southeast Asia, Africa, East, and Eastern Europe, but those are largely net oil exporters and the financially fragile economies. So in terms of payment, the local currencies, number one, with the oil price continue to decline, we already hear, and see projects contracts got canceled from Eastern countries, right? Whether it's construction or it's purchase of PP&E due to the contracting economies and therefore sovereign purchase power and the real economy purchasing power. And number two is the payment terms will probably weaken because those countries, the local currency weakening. You see what I mean?
Yeah.
So like when you export,
it's a very complex picture, and I think I wouldn't bet on the Middle East markets if I wanted to promote my exports. But let me cite you two examples of what I think is happening on a broader scale. The Massachusetts Rapid Transport Authority which is the Boston subway essentially, contracted one of the two largest state-owned train manufacturing companies to build 340 subway cars for the Boston subway. All of these cars will be actually built by a Chinese subsidiary in Springfield, Massachusetts. Contract value is about $670 million. Small bit. But this is an example of what is happening. It's Chinese heavy equipment companies that are now beginning to penetrate the train market, the locomotive market. Rio de Janeiro, the site for the Summer Olympics in 2020 or something, in the next few years, is building a huge new subway system in Rio de Janeiro. They contracted a Chinese train manufacturing companies for the first 34 complete trains. The first of those trains has just been delivered from China to Rio de Janeiro. This is what I was referring to when I was suggesting that it is no longer only manufacturing exports that the Chinese are good at, it's also construction and heavy equipment.
So what's the cost arbitrage here, or it's really exporting expertise?
No, they export the trains and the locomotives and the maintenance systems and the service systems.
So
they signed a contract with Mexico for $3.7 billion to build a rapid, high-speed train between Mexico City and Querétaro, which is close to the Pacific coast. After it had been signed, the Mexican government nixed the contract. Why, I don't know. This had not been announced. Presumably some irregularity in the bidding. But the Chinese are gaining contracts for heavy equipment and big construction projects all over the world now.
Last part of the competitiveness was based on very inexpensive long-term financing from the Chinese Exim Bank, because they're not part of the consensus rates there, and they can undercut everybody else, and also loans from China Development Bank for the same purpose. I don't know if that's true of these recent contracts, but that was certainly part of Chinese SOE competitiveness in the past.
Yeah, I agree with Chris. I think that's an important point. So they're paying for their export contracts in subsidized credit. Yeah, we are in a situation of high uncertainty and volatility, and that period is not likely to be over anytime soon. But the expectation of a hard landing or a crash in the financial sector, I think, is overblown.